first up, we've got Fireside chat with Michael Rubio, Director of Sustainability at Chevron, to kick us off and start us. So, Mike, thanks for being here today and welcome. Let's kick things off. I think, obviously, Michael, Chevron doesn't see oil and gas demand falling anytime soon. And you have a very, I'd say, different strategy to your industry peers, which is to leverage your strengths to safely deliver low-carbon energy to the world and to a growing world. Are you able just to differentiate Chevron's transition strategy from your European peers? You're obviously putting a lot of work into cleaning up the molecule, where by contrast your peers over the pond are maybe doing more work in investing in electrification of the sector and keep growing out their portfolios there. So maybe you can just start us off by providing a little context there.
Sure, Ben, but first let me thank the Energy Council and all of you for joining us today and tomorrow. And really want to thank the New York Stock Exchange as well. As many of you know, Chevron's been listed here for more than a century. It's hard to believe that more than 100 years we've been listed here. We're really proud to do so, but it's mainly because we stay true to who we are. And so I'm glad, Ben, that you actually read our strategy, and it's pretty simple. We think the world's going to grow. People are going to have babies, and developing nations are going to continue to develop. We believe the future of energy is lower carbon, so we want to produce that energy that the world needs with a lower or smaller carbon footprint. And we want to leverage our strengths. We don't really want to be someone or a company that we're really not good at. And so we've got a proven track record at really focusing in on the molecule or the liquid side of the energy transition or the energy system. And we want to ensure that we're able to lower the carbon intensity of that energy system. And so, about 2020, Ben, I got a lot of questions of, why can't you be more like your European peers? And I will tell you is, I said, you want our European peers to do what they're doing, but you need us to do what we do as well. And let me explain why. I like to take this complicated topic and try to simplify it a little bit for you, which is, the world wants to go on a carbon diet, but doesn't know what to eat. And so if we're going to achieve the Paris Agreement, we've got to do three things. One, we have to become widely more efficient in everything that we do. And so if you're building buildings, you got to make those buildings more efficient. If you're a human being, you have to change your behaviors, and you've got to be wiser and smarter about not only your consumption, but the energy that you're using. Second, we have to electrify everything that we possibly can as quickly as we can, and we have to get that electron then from a zero carbon source. And so for some of our European peers that are looking to transition away from being an oil and gas company to generate an electron, great, good for them. We need them to be very successful. But the third thing that we need to do as global citizens to reach the Paris Agreement is we need to lower the carbon intensity of everything that you can electrify. And there's really a misnomer right now around the world suggesting that solar and wind farms are going to solve everything. It's not. Many of you probably flew here to New York to participate in this conference. I was in London last week, and I'm really grateful that we have invented as humans is one thing called an airplane, but it's not going to run on solar panels anytime soon. And so we need to do all three of those things really, really well as global citizens and as global companies. And so you want our European peers to be successful in transitioning, but we desperately need someone to be able to lower the carbon intensity of all those things that we can electrify. And here's the real key thing, and I hope that we get to talk about it, Ben, a bit, not only this morning, but I'd love to hear from all of you, because we certainly don't have all the answers. We haven't yet figured out how to measure or assess performance for those companies that have a strategy to decarbonize or lower the carbon intensity of things you can electrify. If we don't figure it out, we're going to get a very disorderly transition, and we're seeing that today. And so I'm really looking forward to the conversation this morning.
Yeah. No, fantastic. We'll definitely come on to that topic. But first of all, I want to, touch on Chevron's stock has performed well in recent years, continues to climb. I think it's impressive given the pressure the industry has been under from its shareholders and obviously the unprecedented outflow of capital we've seen from the space in recent years. I know when we've spoken in the past, we've spoken about how there are different groups of investors. There are perhaps 20% of the investor universe who have left oil and gas for good. They're saying we don't want exposure to fossil fuels, we're not coming back. There are 20% who are saying we're in oil and gas till we die, we're diehard supporters of the industry. And then you've got 60% of investors who reside in the middle of the spectrum. And I guess the question I'd put to you is, what are the key metrics that investors are using to measure performance, and what does the industry need to demonstrate in order to win over and educate the generalist investor and ultimately attract them back to the space?
I think it's a great question, Vin, and I think that first and foremost, the reason why our sector fell out of favor in the last decade, and let's be real honest with ourselves here this morning, we didn't cover our cost of capital. We were chasing volume, not value, and that's completely changed. So people will try to say, all these headwinds out, energy transition were true, and they were very real. I'm not discounting. But the real issue at heart is we were not covering our cost of capital. We weren't returning cash to shareholders. That's changed. And so moving forward now, how do we deliver higher returns and lower carbon? And so you need metrics and you need the ability to assess performance on both. On the higher returns, it's pretty simple. What's your balance sheet? Really proud of the balance sheet that Chevron has today. It's really because of our long, consistent, disciplined approach to managing our portfolio and our CapEx. There's free cash flow. There's return on capital employed. We've got very mature systems and targets to measure the higher return side of our objectives. We don't have the same matured targets to assess performance for lower carbon. So where do we need to go? At Chevron, we believe that, again, if the world truly wants to go on the diet and learn what calories it's eating, so to speak, then it needs to have true carbon footprinting across the full value chain. And in the front part of that value chain, if we are delivering a commodity, then everyone should know what's the carbon intensity of that commodity. So we've developed targets both on the commodity and on the equity basis. So if we produce oil, you're going to know what the carbon intensity of that oil, the barrel, is. If we're going to produce gas in the barrel equivalent, you're going to know what the carbon intensity is. Everyone here who has a car knows what the miles per gallon of that car is. You ought to know the same about the commodity for which you're buying from a particular company. And that's true for all commodities, not just oil or gas. And then you should be able to follow that molecule or that electron through the full value chain and understand what's the performance. And then hopefully then the market will start rewarding those that are generating higher returns and a lower carbon product as well. I will tell you though, we're a real far ways from that. The market today is not avoided. I mean, just ask the airlines, ask the automobile manufacturers, ask power generators if they're buying, LNG that comes with a certificate or a net zero profile. We're just not seeing it today, particularly if you look at sustainable aviation.
Thank you, Michael. And I should have said we're going to try and come into some questions from the audience if we've got time at the end, so please do submit those questions on Slido and we'll try and get them up. But moving on, I guess are you able to provide some insights into how Chevron's disclosures have evolved to help investors understand the credibility and the resilience of its long-term energy transition strategy?
It's evolved a lot. And for those investors in the room, I see some familiar faces. Thank you, because your fingerprints are all over our financial and voluntary disclosures. Our climate report, our sustainability report. Last year, we issued a methane report. Our goal is to be responsive. And again, we don't have all the answers. This is a partnership. And so we work with our shareholders, work with key stakeholders, Climate Action 100 Plus being one of them. And we learn and try to understand what is it that the world needs to know to assess that performance and then reward it. This is not Little League baseball. There are going to be winners and losers in this energy transition. And I like what J.D. Diamond says, where we're likely transitioning from a virtuous cycle to a volatile cycle. In a more volatile cycle, there's going to be losers and there will be winners. And so how do you assess that? And so our disclosures have evolved a bit over time. One, enhancing transparency. Two, disclosing more about the oversight by our board, the strategy that the company's deploying, and then ultimately how we're measuring and tying that to executive compensation. And not only executive compensation, but at Chevron, we were one of the first to apply it to our variable compensation or the annual bonus. So assistants at Chevron have an incentive to find solutions to decarbonize the business, and so do our executives. So it's shared across the full enterprise.
Brilliant. Thanks, Michael. And I guess, again, one of the key bits of feedback we received in the advisory board meeting, which was attended by the investor groups that we're alluding to here, referring to, was around the frameworks that are available to measure the progress that you're talking about, to measure, I guess, the impact of some of the changes and strategies that are in place. So, but again, feedback we received is there's so many frameworks out there. So what frameworks are available? What are the tools for implementing these frameworks? What are the barriers to success? And finally, what do you think is most useful from an investor perspective? What key metrics or bits of information that's important to disclose as an edge?
Well, I hope you all solve it in the next 2 days. To put a play on Ben's name, it is the Wild West right now with respect to his question and the standards that are needed to assess performance. Again, I like to focus on what we've done right as partners in this journey together. TCFD works really well. It's a framework for decision making, and it sets forth then the framework that companies should report out on what's expected of them or how they intend to manage the energy transition. Where we hadn't gotten it right then are what are those targets that should be included in TCFD. So you've got SBTI, you've got SASB, you've got IFR, you've got all these different groups that are developing these targets and trying to say, we have the right target. And really, it's more about where your view is shaped by where you live. A lot of this stuff is coming from the European continent, and I would caution folks, the European continent might reach its net zero ambitions, but it's largely because it's going to become a consumer and not a producer. And you need to produce product in the world. You saw recently they developed a border cost adjustment. That's just a different name for a border tax, using the price of energy on a developed nation. If you're a developing nation, you're less likely to do that, and you're creating a fragmented, uneven world. And so with the different types of targets that are established for these companies, it's a real challenge, and it creates a more fragmented environment that we're trying to operate in. And so I think that's where it's really important to try to determine where you are as a company, where do you fit in the energy transition, going back to those 3 levers that we have to pull. And I would say where we have perhaps got it right is for those companies trying to move from a more carbon-intensive business to electrification, primarily renewables. We have the right targets and metrics. It's pretty simple and straightforward. For those that are trying to lower the carbon intensity and for that cannot be electrified, we haven't really settled on it. We haven't gotten it right. And we need to get our heads together to try to figure it out moving forward.
Thanks, Michael. And I think then bringing back some of your opening remarks and in the first question I put to you in terms of achieving consistency and maybe being able to benchmark the performance of one company versus another is very difficult, right? I guess benchmarking a company like Chevron's progress against a small independent progress would be a very different kettle of fish. It's near impossible maybe to draw the comparison. But I mean, the question to you is how can we achieve consistency when it comes to the metrics that investors use to validate a company from a sustainability perspective? If we try to simplify it down, what are the key metrics that investors and operators alike need to draw on to measure both progress and impacts?
I just think we have to simplify a bit. If you're developing a product, you ought to disclose what's the carbon intensity of that product and what's the absolute emissions from that product. Then secondly, how are you going to assess performance? Believe it or not, you want Chevron's absolute Scope 3 targets in the near term likely to July, because that means we're producing more responsible barrels of oil and gas that are in high demand today. So if you actually imposed an absolute Scope 3 target in Chevron, it's the worst timing that you would want. But if you want it for a company that's shifting from oil and gas to generating renewable energy, it's a perfect metric and target. That's one. Two, the world is becoming more fragmented. And I don't know, Ben, if we could have one target for all regions of the world. I was just in Southeast Asia, and it's completely different there versus Europe, versus the United States, for South America. G and ESG, folks are saying today, it doesn't stand for governance anymore, it stands for geopolitics. And it's true, we're seeing energy being weaponized. And so how we navigate that, but I do think with all those headwinds, with all the volatility, the most simplistic thing we can do is look at the carbon intensity of what product is being made. Look at it on an equity basis so you don't get to shift emissions off your books and enjoy the financial benefits of a particular product. But we're seeing a lot of that. I mean, folks, look at the GHG emissions in the last year and this year. They're going up. Despite everybody pledging to net zero, we've achieved these reductions based on this baseline. No, look at the performance of a company and how it's performing a particular product, and then benchmark. Where does it benchmark amongst its peers? So you could benchmark Chevron's production of oil and gas with an E&P or a large integrated. On the refining side, you can look at it compared to just a pure refining play company or another integrated. But we've got to start thinking about what are we trying to achieve and then work backwards from that.
Thanks, Michael. Well, I think we've got about 5 minutes for questions if anyone in the audience did want to put their hand up and shout out. I don't know if it's possible to get a microphone to go around the room, but first of all, they just have to shout at them. So does anyone have any questions that they would want to put to Michael? Don't all jump at once.
It's too early. Morning, is there a head buffer? Yeah, it was a brave soul.
If we got a mic.
I can try to speak. Can you hear me or no? I can hear. Can you actually walk us through the process of measuring the carbon intensity of a single barrel of oil that you produce? Like, or do you have estimates? Because I think as investors, obviously, some of the information we get is disclosed from companies, other third-party vendor estimates that are like wildly inconsistent. But can you actually walk us through how Chevron measures the carbon intensity of a barrel?
Yeah, it's a great question. For those who couldn't hear it, it's how do you actually measure greenhouse gases? Remember I was talking about higher returns, lower carbon? We have very sophisticated systems to track financial data and information. We don't have those same systems for greenhouse gases. And so it's a real issue. In fact, this year, we've achieved reasonable assurance for those wonks in the room. It means that we have high confidence now in the data that's coming in. It's taken us years to achieve that from limited to reasonable assurance of the data. And so we do a combination of direct measurement, but also a lot of mission-based factors. We know things out in the field actually emit, and believe it or not, some of them emit by design because of the safety issues. There's a lot of pressure in our equipment and facilities, and so they will be triggered and they'll release things like methane or other greenhouse gases. We also know that greenhouse gas, particularly CO2, it's just a function of energy. And so the energy coming in, the energy coming out, we could actually calculate it, determine what it is. So if you have a heavier crude, for example, the level of energy it takes to bring that crude up out of the ground is going to be higher. Therefore, the CO2 intensity level of that production and actually is going to be higher. And CO2 is different than NOx and SOx, air quality, things where you can filter. We have to actually capture it, move it, and then store it, or we have to reduce the energy so you don't have it on the front end, so you don't have it on the back end. And so we go out and we measure our entire operations. And then the second thing we do is we do what's called the marginal abatement cost curve project against those measurements. So we use the MAC tool to then identify where are we going to get the biggest reduction for every shareholder dollar that we stick, which is really critical because cost discipline matters in our traditional business, but it's really important in the energy transition space as well. And so then, and if you look at our data tables, we then try to break out all those measurements for you, and then use the GHG protocol that's issued to use that as the standards and then set if there are questions. Scope 3 emissions, for example, we have to list 3 different calculations because there are 3 different types of approaches. So do you just issue 1, do you issue 2, and we debated it within the team, so just do all 3.
Thanks, Michael. I saw a question pop up on Slido as well around the importance of, it's not on the screen anymore, the third-party certification, and actually the importance of having third-party come in to certify the data that's being provided so that investors can trust that what they're being told by energy companies is reliable, is true. I don't know if you care to comment on that.
It is important. I mean, we have a trust issue in this space. And so as we evolve in developing the systems and the processes, it's going to be critical to have that third-party entity. There's a call for more auditing. I can tell you the big auditing firms, I don't know if there's any in the room, they love this idea because it's another book of business for them. And so it's going to be important moving forward.
Brilliant. If I just look at the questions coming up on screen, there's one coming around the topic of Europe there. With Europe ahead in carbon frameworks and targets and global capital, does North America need to move quickly to common target and report?
I think history is a really important indicator for us. It wasn't long ago that the most important price in the oil and gas business is the commodity price, and it wasn't too long ago we were trading below 0. And you got to learn really quick who were the strong companies and which were the weak companies. You saw consolidation, you saw companies cut the dividend, you saw companies cut benefits for employees, you learned real quick who was strong and who was weak. The premise of the question, I think, is flawed. Europe is ahead. I don't think anyone's being rewarded for being ahead today. And so I don't know if they're getting it right. They may be out in front in trying to develop what they believe is the right targets or metrics, but it's for a very unique continent that has very different ambitions and goals. I said they're largely going to be a consumer moving forward. And they got really lucky they had a mild winter. The United States wants to be a producer. I'm not a politician, but I'm a retired one. But, that is the reality in America. And therefore, I wouldn't subscribe to the notion that they're ahead. I just think we're going to approach it differently. And I would encourage us to do that because we need to blade on blade sharpen it and make sure that we're doing the best that we possibly can.
Brilliant. Like Michael, I think time's up. That's a great note to round up the conversation. So thank you for your time.
Thank you for that.